Well, a warm welcome to everyone, and thank you for joining us today. My name's Joel Carty from Solace Financial, which is a locally owned and locally staffed firm in Brisbane. Today we have Sequeira from Australian Eagle Asset Management. Sean, a founding member of the company, has been the Chief Investment Officer since 2016. With over 30 years of industry experience, he leads the investment team and oversees the entire investment process. Sean chairs several key committees and plays a crucial role in the portfolio construction. Before co-founding the company, he gained experience at a European investment bank in the late 1990s and later worked in Australian equities at Tower Asset Management. Sean is also a Chartered Financial Analyst, or CFA, and holds a Bachelor of Business in Finance and Economics. Outside of work, he enjoys his family time and martial arts, where he trains as an instructor. But before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your objectives, your financial situation or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting upon it. Please also refer to any product disclosure statement, which provides an overview of the product before making a decision. Details of this financial advice, general advice warning can also be found at the moneysmart.gov.au website. Thanks for joining me today, Sean. As a fund manager specialising in Australian equities, can you talk us through Australian Eagle Asset Management history and investment philosophy?
Oh yeah, absolutely. So we've been managing money for 20 years, just under 20 years actually. We started off long only manager, which means that we only had stocks in the long side of the portfolio. We only bought stocks. And then about 8 years ago, we started a long short fund. That's utilising our strength, or what we perceived as strengths in the long only, and extending that into a long short to try and enhance returns.
Okay. So what is the investment process that you guys use?
Well, we are fundamentally based. That means we analyse each individual stock from a fundamental basis.
Yeah.
Where we choose the qualitative and quantitative measures of a stock, and try and identify stocks that we think will outperform. And we use our process that we've developed and used over 20 years. That's outperformed the market by a considerable margin, actually.
Okay.
And we have utilised that process consistently in that time. Now, if you want to know a little bit more about that process, that is a process where we try and identify something that is changing within a company.
Okay.
And that change we want to view through the prism of quality and valuation.
Okay.
Now, no one's going to tell you that we'll buy poor quality stocks and we want to overpay for them.
Yeah.
That'll be great. I'd love that. But what we try and do is buy stocks where we believe they have above average quality. Okay. And where we have a measure of downside protection from the valuation. We don't necessarily want to overpay for that.
And
now,
Ben
importantly,
Graham's theory of margin of safety.
Yeah, indeed. You can use that as well. More importantly, and probably what differentiates us from other people and other managers, is that we try, when we enter into a stock, we try and identify what is changing within that company. And if we can identify that, you can have the potential for outsized returns from that company.
Right, okay.
Our view is, if we really want to drive into it, is that our view is that the market handles consistency very well. If you take a stable growing company and everything around it is quite consistent, it gets to a valuation, the correct valuation, very quickly. However, companies are dynamic.
Yeah.
And the market really doesn't process change very well. So we are more longer term focused. We'll say, well, what's changing within the next 3 to 5 years? And we try and identify that change and manage the risks around that change. Okay. And in doing so, we give the optionality for that company and allow it to potentially outperform strongly.
Right, okay. Moving on to risk, how do you assess the risk when you make your investment decisions?
Well, that comes in multiple facets of the process. It starts off with the individual company. I mentioned earlier margin of safety of the valuation. That's an easy one. Everyone will do that. Where the other thing that's really important to us is quality.
Okay.
If we actually start with quality. We don't start with the valuation. If you start with quality, at the worst case scenario, you've got a good quality asset that has a very strong balance sheet, has a competitive advantage, good management. Those things are supported by the market. That is your first port of call in terms of determining risk of the company. If it's poor quality and there's quite a few companies that are over leveraged, that have poor management, are in a poor market position relative to their competitors. If it's poor quality, it's not considered for the portfolio. Why? It's because it can come under catastrophic risk at any point in time. Well, if the first port of call is quality, then you reduce that level of risk. Now, the next part is obviously the valuation. And then what we do is we try and identify what is changing. But we try and identify that with concrete evidence. If you have concrete evidence that something is changing, it's not a figment of your imagination. You can actually identify that piece of objective information, then that's your next level of risk that's being mitigated. So you'll know that these changes are occurring, because the hardest thing to do is manage the risk around change. We've been doing that over 20 years, and that's what's driven our outperformance over that long period of time. And in doing so, that's the next piece of risk that we try and mitigate. Then after that, the next thing is it goes into the portfolio. Well, what risk is it replacing? You don't want to, when you're a bottom-up stock picker, that means you're individually choosing the stocks that you like. You can accumulate risk in the portfolio. Now, what we do after that is when we choose a stock that we like, we say, well, what does this replace in the portfolio? You're replacing risk in the portfolio. So we try and replace a different company that has the same risk profile as the one that we're putting in. And that way, overall, the portfolio maintains a certain level of risk. Now, as part of that, you do accept certain risks. You must accept certain risks in your portfolio to make a return. And that might be, we tend to have high quality stocks in our long portfolio and low quality stocks in our short portfolio. That means sometimes low quality stocks run and you will underperform. It's usually when the market's running very strongly. You will underperform, but in longer periods of time, that works itself back out, and over time, high quality stocks tend to outperform low quality stocks, which tend to underperform the market as well.
Okay, so when we talk about high quality stocks, low quality stocks, what are the opportunities and risks that you see in the market at the moment?
Well, we've had a period, particularly over the last couple of years, where the market has rebased from thinking that things were being quite negative in terms of the economic environment, and stocks that were low quality fell. They were bought back up once the market started to think that we're having a soft landing. There's no downturn. Interest rates will start to come down. They were bought back up and were repriced. That has been a bit of a headwind, but that left a number of high quality stocks really trailing the market. And those stocks, some are in the healthcare sector. Some are actually have good assets behind them. That some REITs, even some high quality resource stocks, have been left behind, and that's where we see certain opportunities for our portfolio.
Okay.
And we've been slowly picking up some of those stocks, but mostly those stocks that we can rely on to get through any difficult period, have very good balance sheets, have very high quality assets, and that's what we want to build our portfolio with, because whether we go through a downturn or a significant upturn, those stocks will continue to grow and continue to provide cash flows.
Okay, so what is Australian Eagle Asset Management's greatest strengths as a fund manager?
Well, I suppose the first thing that we would say, we tend to be a bit more longer term focused in our views.
Sure.
So we can look through the scrum of the next, a lot of managers, not all, but a lot of managers tend to look for the next quarters or the next half year's earnings as their next port of call of when they'll outperform. We tend to look a little bit longer term. We want to see what's changing in the next 3 to 5 years. And only then do you get the opportunity for outsized returns.
Right.
Because it's that accumulation of improvement in the company that gets valued at a much greater rate. So what you're trying to get is not only the increase in earnings that drives your performance, but the re-rating of the stock because of that change in increase. On top of that, our focus, strong focus on change, which seems to be probably a little bit of a differentiator for us. That strong focus on change means that we've had a long period of time, 20 years, of being able to manage the risks around that. And having that strong focus, managing those risks, we think that having that, being able to do these things allows us to do this probably a little bit better than other people.
Okay. So you mentioned performance and returns. Can you talk us through a time when you've turned a period of poor returns into an investment opportunity and turn the performance around?
Oh, look, being a fund manager and having a fund for 20 years and this one for 8 years, we've gone through multiple cycles. And in doing so, we've gone through cycles of underperforming and outperforming. You have to. When you expose your portfolio to risk, and you must to get a return, you will go through downturns where you're not performing as well as the market, and you'll go through periods of outperformance. We have gone through multiple periods of underperformance, despite the fact that, for our long portfolio, we've outperformed something like 4% per annum over 20 years.
That's pretty impressive.
Well, it puts us, I've been told, I don't know, I've been told it puts us in a very good category of the market. However, we do go through periods of underperformance. And during those periods, we tend to find that the market is just not valuing some of the theses that we see. They're not willing to look a little bit further forward. They get quite myopic, and they want, they'll want the returns or the earnings immediately. They'll look at 3 months, 6 months. Well, we're looking a little bit further forward. When they previously did this was probably between the periods of about 2011 to 2014, 15 even. And we had a period of underperformance and then lackluster performance. But we had built the portfolio with all of these arguments for change within companies that the market were just not looking at. Why? Is because it was 1, 2 years out. And it's almost like building a portfolio of potential energy. And it comes around that the earnings started to reflect what we saw. And coming into 2016, we went through a period where the portfolio strongly outperformed. And that's what we want to do. All we did was remain disciplined to our process of identifying change, building the portfolio full of this almost optionality. And when it does come through, it comes through relatively strongly. And that's what we want to do. We want to maintain the discipline to our process because we know it's worked over many years. And it's very hard to do, particularly when things aren't going your way. We've had a period of that over the last little while. And we believe that if we continue to do what we've done in the last 20 years, we will outperform in time as the market identifies the benefits of the companies that we've invested in.
There's a famous saying by Jocko Willink, our retired Navy SEAL, discipline equals freedom. So it's obvious in this case.
It seems like a little bit of a tautology, actually.
Yeah. So what type of investments have you recently made?
Well, we've as I said, it's been a difficult period, but we've been able to find a number of stocks that really meet our criteria for high quality and change. And they're not just in the same sector. We've recently bought Technology One, which is an excellent company, has been an excellent company for many years. And you'll think, well, what's changed? Well, that's very interesting because Technology One had actually invested over many years into the UK. Actually, probably about 10 years. And over many stops and starts, they haven't really made much money from it. And what we noticed when they first invested in the UK, they had companies that were their clients that weren't their real niche. In Australia, they have a niche in local government and education. It wasn't until we saw a couple of quarters, or a couple of halves actually, of growth in their niche clients that we thought that they now have the critical mass to start to grow in the same manner as what they've done in the last 20 years in Australia. And that could drive not just Australian growth that will continue, but a new leg of growth. And that's the change that we're looking for. So we found that with TNE. We found that with something like ARB, where they grow in a somewhat of a similar manner into the US. Interestingly, we invested into data centers are very, very big in Australia. It's the thing. AI seems to be the biggest sort of growth engine of global investment at the moment. But we identified that despite those data centers in Australia, certain data center companies really rocketing over the last little while. One company have kind of been sort of trailed, and that has been Infratil.
Okay.
It's an infrastructure company. And what we identified within there was that the data center is actually one of the largest in Australia, but it seems to be diluted by other assets. They're an infrastructure asset management company. So they have, 30% of the business is data centers in terms of earnings.
Mm-hmm.
But we see that the other 70% of the business is diluting the focus. And what they did and what changed, something has to change for the market to recognize this. And what we think has changed is that they raised $1 billion recently in the Australian market to grow substantially that data center business, fund that growth, and that focus upon the data center business. That is the thing that we believe will start to drive focus from the market into the superior asset quality that they have within there.
Okay.
On top of that, they're selling other assets. If you start to sell other assets, you're concentrating more and more focus upon this high growing data center business, which is, current valuation should be valued at much higher, particularly relative to that of NextDC and even Goodman Group. But it'll only occur once these changes start to really take shape. And so long as they continue to do this, we expect bigger things from them.
Okay. So how do you stay up to date with all these changes in financial markets?
It's actually not that hard. The only difference between us and everyone else is that we are focused upon what we do. We don't deem ourselves to be superior of superior intelligence. There's plenty of people smarter than us. The thing that we have, that we think that we have, that other people don't have, we have an intense focus upon what we do. We love what we do. Mm-hmm. We do it at all times of day and night. Well, people are sending, my team are sending us each other emails at all times whenever they read something. The thing that we say that is different from us to anyone else is that we're intensely focused upon not only what we do, but the way in which we do it.
Right.
And if you're intensely focused upon something and you love it, you'll be constantly scanning markets. We read insatiably, not just about our actual, financial markets. Everyone listens to podcasts, all those sorts of things. We do the same things.
Yeah.
But anything around any of the companies, any of the science around any of the companies that may interest us, we are always on it. So we can find information from almost anywhere. Stay up to date with the financial markets is pretty easy. There's plenty of information. The trick from our perspective, and as what probably makes a good fund manager, is knowing which information is relevant to you. There is a fire hose of information out there. It's not getting the most information. It's determining what information to leave out. And that's probably what makes a good fund manager, beyond the other bits and pieces that we would ordinarily consider, is that, you have an intense focus, you have a process mm-hmm. that you disciplinedly follow. The other thing, and the final thing that I would say, and I hope that you do want to know what makes a good fund manager. I don't know, but if you do, the other thing that we would say is that a level of humility.
Okay.
You need a level of humility to be able to do what you're doing. You're dealing with uncertainty. Nothing is certain. In science, things are certain. Outcomes are certain. In financial markets, there is uncertainty. And you have to recognize when you are wrong. And potentially that'll happen more than 50% of the time. But on top of that, you also have to be able to have the conviction when you are right to be able to weight those investments correctly. And that's where you make your money. It's not necessarily how many you get wrong. Mm-hmm. Be able to cut those incorrect decisions very quickly. With humility, you can do that. And beyond that, be able to weight your good selections well so that you make an economic return for your clients.
Okay. So Sean, we've covered heaps of ground this morning. So is there anything else that you'd like to add?
No, actually, I think that we've covered almost everything that I would ordinarily say. So other than that, we look to continue to disciplinedly implement our process. And we know in time, we've produced a lot of outperformance. When we go through downturns and upturns, we just hope that, the downturns are shallower and the upturns are much larger.
Okay. Well, Sean, I appreciate you making the time to talk to me today.
Thank you.
All right. If you'd like to talk with Solace Financial regarding your current financial strategy and whether it's suitable for your goals and objectives, please reach out and contact me via our website or give our office a call to schedule an appointment.